Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to Fundamentals, where I'm going to look at one of the most popular exchange-traded funds on the AJ Bell Invest Centre platform right now. It is, and sorry for all the letters, UBS MSCI USA Socially Responsible ETF. Now, an ETF is designed to track the performance of the underlying assets and deliver that performance minus its running costs. In this case, the product is designed to track an MSCI index, MSCI USA Socially Responsible, which uses rigorous checks to determine whether US listed firms are suitable for inclusion or not. What's different about the index, and therefore the tracker, is the tests used to select those stocks. Normally, negative screening is used, whereby certain industries are just excluded. Gambling, tobacco, alcohol, adult entertainment, weapons manufacturing, for example. But this index uses positive screening, which integrates environmental, social and governance or ESG considerations into further analysis of a company. Each firm is actually given a score based on two factors. First, an intangible value assessment, IVA, which ranks firms from AAA the highest to CCC the lowest. And a second impact monitor or ESG rating ranks them from 0 the lowest to 10 the highest. Now, only the highest combined scores are included, and the result is an index specially built of around 150 firms, where no one stock can be more than 5% of the total. Once all of that analysis is complete, UBS MSCI USA Socially Responsible uses physical or direct replication to provide performance, so it owns the underlying securities. In this case, the big five holdings are Microsoft, Procter & Gamble, Intel, Walt Disney, Cisco. By way of sectors, tech, consumer discretionary and healthcare are the biggest three exposures, while utilities, basic materials, mining and telecoms have a much lower profile within this particular MSCI index and therefore the tracker. Now, the tracker comes with an annual ongoing charge figure of 0.33% and has around £285 million in assets under administration. Established in 2011, the product comes with a 2-star Morningstar rating for those who put store by such matters. So those are the mechanics. The question to address next is, why would clients and advisors be interested in this right now? And I suggest there are three possible reasons. First, clients and advisors may still just be seeking exposure to the US and dollar-denominated assets in the wake of the so-called Trump trade, in the hope that the American economy, stock market and currency all get a lift from the new president's planned tax reform, deregulation and infrastructure spending program. Second, of course, the socially responsible element. Most advisors and clients put capital at risk because they want a return that satisfies their personal needs and requirements. Some may do so because they want to make a difference and do good. Many more will be keen that their investments do not do harm and make a difference in a negative way. So the twin screen tests will clearly help here. Third, it's just possible that socially responsible investing can actually help investment returns. In 2012, Deutsche Bank published a research report which asserted that companies with high ratings for corporate social responsibility and ESG factors enjoyed a lower cost of capital in terms of debt and equity. That in turn implies that the market views such firms as lower risk, and that by implication, companies with weak governance who don't pay attention to these issues were seen as higher risk. The performance of the ETF since inception does suggest advisors and clients are not sacrificing performance for their principles, as we can see from the chart here. Now, there are still risks, as a firm that passes the MSCI screen test can still make a mistake and then be excluded, but only after its misdemeanors have come to light. In addition, the Trump trade, well, that could disappoint, and a potentially expensive-looking US stock market could start to flag and lose momentum if that's the case. Advisors and clients will therefore need to ensure that the ETF does fit with their overall strategy, target returns, appetite for risk, and time horizon before they put any capital to work. Thank you for watching, and I look forward to seeing you next time.